plans have been drawn up on a private scale. So against the backdrop of the current debate on the euro and the financial future of the country, Roland Berger Strategy Consultants, a German company, presented a recovery plan for the Greek economy with the aim of protecting the country from bankruptcy and particularly from any exclusion from the eurozone. The goal is to massively cut Greek debt without forcing a haircut on the creditors, and also stimulating the economy and ensuring the stability of the euro. Now, what this plan entails is gathering Greek assets to the tune of 125 billion, if I'm not mistaken, in a holding company that will then be sold to a European institution to manage the assets of the Greek state in order to bring down the debt. On the line, we have Mr. Markus Krall. He is a senior manager for the Roland Berger Strategy Consultant Company to tell us more about it. Could you give us a brief outline of the recovery plan as you see it through the Eureka project? I understand that's what the name is.
Yes, that's correct. I will try to very quickly give you a brief outline summarizing the key features of the plan. The plan is effectively a privatization scheme that is not only different in size, but mainly also different in the way it is conducted. It anticipates that Greece effectively puts all its state assets except cultural heritage sites and a list of excluded assets which are intentionally excluded. So it's effectively taking all assets minus an exclusion list into a holding, and then instead of privatizing the assets in the holding, selling it wholesale to an EU institution for 125 billion euro. This 125 billion euro then would be used to reduce Greek debt in one step to just below 90% of GDP and effectively lift Greece out of the debt trap in one go by repaying all the debt to the Eurozone countries and giving a loan to the EFSF, who would then buy back the bonds from the ECB and also bonds from the markets in the value of about 100 billion, so that the total outstanding debt would be reduced by 125 billion. Now, the second step then would be that the European Union invests 20 to 35 billion, depending whether it is included the infrastructure funds of 15 billion that are currently dormant or not, 20 to 35 billion into these assets to restructure them and maximize their value so that privatization revenues can be maximized. This should happen over a course of 2 to 4 years, and it has the side effect of stimulating the Greek economy with a stimulus package in the size of 14% of Greek GDP, which would lift Greece immediately out of the current depression, create growth and jobs, and stop the downward spiral that the current savings and austerity program has been forcing onto the country.
That's very clear. Thank you very much for that. But why is it necessary to create the holding company, and why should it be sold to a European institution?
Well, the European institution would be the only source of 125 billion that is available. That is one element. And the second element is that by selling it wholesale to a European privatization institution, we can effectively reduce Greek debt in one step instead of reducing it slowly. And this one big step is necessary to give Greece back an A rating level perception in the debt markets. Because when you look at the total impact of this program, first of all, the debt burden is reduced by over 40%. So the expenditure for interest also goes down by over 40%. Secondly, the growth program of 14% of GDP spending on investments will trigger a whole reversal of the capital flight. Many of the privatizations effectively will be taken up by Greece citizens and institutions who will have a right of first refusal in that plan also, which is important to us because we think it's not only about privatization, it's effectively about taking these assets out of the state's hand and giving them back to Greece's citizens. Now, this will have an impact on growth. We anticipate that growth will effectively jump to 4 to 5% plus instead of 5 to 6% minus, which in turn will also increase tax revenues drastically. And that puts Greece in a position to be able to fund itself again on all fronts. It will have a balanced fiscal situation, and it will be able to have access of its own to the capital markets again.
Now, that's all well and understood, but I still don't understand why a European institution. Why not the Chinese? Why not the Russians? Why not the U.S.?
Well, if a U.S. institution would come up with 125 billion, that would also be an option. But you have to see that there's also an asset price risk involved in that. It is very difficult to estimate the value of the Greek total state assets at this point in time. The range is between 75 and 300 billion. And although we have included mitigation measures in the plan, it is very unlikely that a Chinese institution or any other institution outside Europe would come up with 125 billion for this privatization scheme. Also, what we plan to do here is that there will be a kind of an approval paper for Greece. For example, if the privatization yields significantly more than the 125 billion euro, let's say 200 billion, which is a possibility if you do it over a long time and if you invest into the assets, then Greece will also participate fully from the surplus. Other investors effectively would look for gaining a profit on their equity investment, which would then not be at the advantage of Greece.
Now, you mentioned that the range of Greek state assets, depending on how one views it and depending what one includes, is between 75 and 300 billion. What percentage of state assets would this include? How would you classify the assets that are to be placed in this fund? You mentioned that cultural heritage will not be included, but also some other things would not be included which were not specified. What would be included?
Well, actually, in the first place, everything would be included, and the reason for that is that there's no full inventory available. This full inventory will take time, so in the first place, everything would be included, but to make sure that certain assets which are also a matter of national pride should not fall under privatization scheme, obviously, they can be then included in a negative list. That's how we proceed, because a positive list saying we create a list of all assets that go in there will take too much time to create, and therefore that would cost too much time for Greece to start this rescue program. That's the first element. The second element is, how do we classify the assets? Well, there's already a classification in the privatization scheme that has been started, or
yes, there is.
That has been initiated now, which we think cannot work because it puts Greece under a pressure to sell things fast in a depression situation, which will only lead to a situation that valuable assets will be sold well below their long-term value, which is also clear when you look, for example, at the Athens Stock Exchange, where prices are about a tenth to a fifth of their peak value 3 years ago and less than a third of their average value of the last 10 years. So this is not the right time, effectively, to privatize. That's also one of the reasons why we think it has to be a European institution. It does have the time. It can take 5 to 10 years to privatize all these assets, especially when the focus is to ideally privatize it, much of it to Greek investors. We'll classify that into segments like infrastructure, like ports, like airports, like real estate, etc. But that's more of a technical question that comes later in detail.